The live closing price for Pfizer Inc., New York Stock Exchange, ticker PFE, as of the market close on Monday, November 4, 2025, was $24.30, marking a slight dip of 36 cents or 1.46% from its previous close. This single figure, $24.30, represents the common, almost dismissive market expectation that Pfizer is stuck in a post-pandemic slump, forever anchored by the inevitable decline in its COVID-19 related product sales. But that single figure, sitting near its 52-week lows, completely misses the deeper, more complex story unfolding beneath the surface, a story that involves a major, unexpected legal skirmish in a red-hot therapeutic area and a crucial pivot in their business model that far exceeds the street's current lackluster view. The true surprise that analysts are whispering about over their morning coffee isn't the declining revenue, which was entirely expected, but the simultaneous and dramatic raise in full-year adjusted earnings per share guidance that followed the recent earnings report. This divergence, a revenue miss but a huge EPS beat that led to raised guidance, creates a fascinating tension between the market's simple narrative of decline and the operational reality of a leaner, more focused Pfizer. It signals that management is executing a cost-saving and efficiency strategy with a ruthlessness the market clearly underestimated, proving their ability to find profit even as the massive pandemic tailwinds fade. This immediate unexpected insight is what an individual brokerage or even a general investing sites might gloss over, but it's the core of the current value debate. The general belief among casual investors and those following broad market headlines is that the Pfizer stock story is defined by the sharp drop-off in sales for Paxlovid and Comirnaty. For nearly 3 years, these products were the undisputed champions, delivering staggering, unprecedented revenue that masked structural issues and inflated the stock price, only to lead to a severe reckoning as those sales normalized. The common wisdom is that Pfizer's core pipeline isn't strong enough or its acquisitions aren't integrating fast enough to bridge this massive revenue gap. But a closer look at the recent trading action and the institutional holdings tells a different story of calculated accumulation and strategic defensive maneuvers. While the daily price movement of PFE, like the 1.46% dip we saw yesterday, can feel frustrating, the trading volume on those days has often been massive, recently spiking to over 166 million shares, significantly higher than its average volume. This high volume on a down day is often cited as a bearish indicator, but when you couple it with the institutional activity, where we see large holders like Vanguard and BlackRock holding hundreds of millions of shares and some funds even increasing their positions, it suggests that the smart money is viewing price dips as opportunities to consolidate a long-term investment, seeing value where others see only risk. They are betting on the company's ability to successfully transition away from the pandemic cash cow, utilizing the profits from that era to fund a new future, a classic expectation versus reality mismatch. One area that is currently dominating the expectations for Pfizer is the battle for dominance in the obesity and metabolic health space, which brings us to the unexpected legal theater. Pfizer is not just passively losing the fight to competitors like Novo Nordisk, it is actively and aggressively fighting back through the courts. Their second lawsuit, asserting federal antitrust claims against Metsera and Novo Nordisk over the proposed acquisition, is a strategic, high-stakes move. This is not the typical pharmaceutical patent dispute. It's an aggressive play aimed at preserving competition and, crucially, protecting Pfizer's own early-stage assets in the GLP-1 sector from being stifled by a dominant player. The market is expecting Pfizer to simply develop an inferior drug and fail to compete, but the reality is they are employing both legal and scientific tools to reshape the competitive landscape. This legal action, though a costly headline now, speaks to the depth of management's conviction about their own obesity drug pipeline and its potential. If Pfizer were truly out of the weight loss race, they wouldn't commit to this level of legal antagonism. This is a crucial detail for anyone performing self-investing or looking for investment help that goes beyond simple financial ratios. They are using their sheer size and legal muscle, which is a powerful, often overlooked competitive advantage that smaller firms focused on online investing cannot replicate. Looking into the operational mechanics, which is where the raised EPS guidance came from, the focus shifts to efficiency. Pfizer's cost reduction initiatives are on track to deliver at least $5.5 billion in net cost savings, with $4 billion anticipated by the end of 2024 alone. This is the structural reality that is defying the revenue-centric expectations. They are aggressively trimming the fat associated with the scale-up of pandemic production and are realigning their entire cost base. This explains the significant EPS beat in the most recent quarter. Cost control was tight, margins were strong, adjusted gross margin was a robust 76%, and the company has essentially given itself an operational buffer to allow the new non-COVID products to grow into their shoes. The core global biopharmaceuticals business, excluding the COVID-19 products, is where the genuine, albeit less dramatic, growth is happening, with a 14% operational increase reported. Products like the Vindalkale family for amyloidosis, the oncology portfolio including Xtandi and Padcev, and their vaccines portfolio are all showing solid double-digit growth. This is the steady, foundational strength of the company's business model, diversified drugs targeting chronic, high-value conditions that is often lost in the noise of the single-product revenue decline narrative. Anyone managing an intelligent portfolio or relying on an online investment platform for their strategy needs to look past the top-line revenue numbers and appreciate this significant operational dexterity. Now, let's turn our attention to the overall company structure and what Pfizer actually does when it's not making global headlines. Pfizer, founded in 1849, is one of the world's largest pharmaceutical companies, engaged in the discovery, development, manufacture, and marketing of healthcare products worldwide. Its product lines are vast, covering internal medicine, vaccines, oncology, inflammation and immunology, and rare diseases. This sheer breadth is a major asset. The company operates through two main segments, Pfizer Biopharmaceuticals Group and Pfizer Center One, the latter focusing on contract manufacturing. The business model is classic big pharma, a continuous cycle of internal research and development combined with strategic mergers and acquisitions, like the highly publicized but often misunderstood acquisition of Seagen, which is a key component of their oncology growth engine. This model produces a robust stream of drugs, creating intellectual property that generates high margins for a long period, protected by patents. The dividend, which currently offers a very high yield, is a direct reflection of the long-term cash flow generated by this model, making it a compelling consideration for those using a service like Schwab Intelligent Portfolios or building a portfolio through Fidelity. This kind of consistent capital return is a powerful countersignal to the doom and gloom narrative that has plagued the Pfizer stock price. The recent stock price movement has been choppy, defined by reaction to these contrasting narratives. After the initial post-earnings dip, which saw the stock touch the lower end of its recent range, it has tried to establish a new base. High institutional trading volume suggests strong disagreement on its fair value. On one side are the value investors, drawn in by the low PE ratio, the high dividend yield, and the strong operational efficiencies. On the other are the growth-focused funds, nervous about the revenue guidance and the competitive pressures in the obesity space, looking for the quick wins offered by companies like Nvidia stock or Tesla stock. This tension has created a sideways trading pattern, which can be frustrating for those using a Robinhood stock trading app for quick swings, but is a perfect consolidation pattern for long-term investors. The stock is essentially coiled, waiting for a definitive catalyst to break it one way or the other, and that catalyst is likely to be a major clinical trial readout or a clear resolution to the Metsera legal battle, not another quarterly earnings report showing expected COVID-related declines. Let's shift to the forward outlook, where the expectation versus reality principle becomes most critical. The market's expectation is a slow, grinding recovery, constantly fighting against the perception that the company peaked during the pandemic. The reality, however, points to several strong potential catalysts. First, the successful integration and performance of the Seagen oncology assets is key. Oncology is a high-growth, high-margin field, and early signs of growth from Padcev and others are very encouraging. Second, their internal pipeline has multiple late-stage candidates in areas like rare diseases and vaccines. A few successful Phase 3 readouts could completely change the market's perception of Pfizer's core growth engine. Third, the long-term success of their efforts in the GLP-1 obesity space, whether through the legal defense of a nascent competitor or the advancement of their own oral candidates, remains the single largest upward swing. If they can successfully execute on even two of these three fronts, the stock's current valuation of $24.30 will look absurdly cheap in hindsight. The risk, of course, is execution failure, a prolonged legal battle